India has returned $135 billion of cash.
Wow.
This has never happened in India's history.
India has some 100 plus unicorns. How many of them are fairly valuated and how many are yet to grow into that valuation?
I would more like say 70-30. I may get a lot of hate mails after this. You got to be where the puck is going to be, not where the puck is.
Anand Prasanna is the managing partner at Iron Pillar, a $400 million VC fund backing growth stage Indian startups like Bluestone and Cure Foods.
AI theme in our view, honestly, is overhyped at this point of time. A lot of money is going to get destroyed in the current AI hype cycle. I've always seen people underestimating India on the long term and overestimating India on the short term.
I want to give you some names and hear your take on whether you would have invested in them or not. Zepto. So, Anand, you run a growth stage VC fund, and
Yes.
I have interviewed a lot of VC funds who are more on the early stage. So based on my limited understanding, it seems like there are a lot more early stage funds than growth stage funds. Help me understand the difference between a growth stage fund and early stage fund. What does that pyramid look like? Like for every 100 early stage funds, how many growth stage funds are there? Just as an example.
Yeah, it's very good, actually. In fact, last week, I was in a conference and somebody told me about this same issue. Like, there's a lot of early stage funds, very few growth stage funds. And actually, then there is a lot of late stage investors. So how do you guys operate? So if you look across the world, that is the case. It's not really very abnormal to see that because early stage, first of all, the capital you require to put to work is smaller and the number of opportunities are very, very large, but only
Can
a
you
small
also
percentage.
define early stage with some names as well? Like say these would be early
Yeah.
stage funds.
So if you look at India, for example, funds like Bloom is an early stage fund. India Quotient is an early stage fund. Arkham is an early stage fund. Stellaris is an early stage fund. So folks like that are early stage funds. And then there are obviously global names who primarily invest in early stage, whether it is an Axel as an example, right? So like Lightspeed as an example, they primarily invest in early stage, but then they double down in the great growth stage or late stage also. Now, when we come from there to say the company, typically these early stage funds, again, if you had to kind of get into the details of it, they could be angel checks, which typically, and again, people need not follow exactly the same way, but an angel check typically means that you just have an idea and you have a check, right? That's actually what an angel provides. A seed stage is when there is a little bit more of movement towards a product, maybe the first MVP of the product is made, etc. That's when a seed stage is supposed to be, but sometimes I see seed investments which are even like some $1 million of revenue also started coming in, or even a few $100,000 revenue started coming in.
What are check sizes also? Like ranges, I'm sure there'll be
So again, these things vary very significantly globally, but in India, the angel checks tend to be $500,000 to $1 million kind of thing. The seed stage checks tend to be, I would say, $1 million to $3 million kind of checks. And then Series A, where you definitely have a couple of million at least of revenue in the business, and you are really kind of giving that capital to kind of really prove out the product market fit, as we say. So at Series A, the checks can be up to 20 million from that 3 million, right? So that's a range. And then comes the growth stage. So at growth stage, typically the expectation is that the company is a $10 million plus revenue. And this could go all the way to probably $50 million revenue, because beyond 50 million, it will be like late stage. In India, sometimes you even see $50 million companies going IPO. So it could be even pre-IPO rounds. So right. 10 to 50 million is actually that growth stage in terms of, I'm again talking about revenue. Valuations can differ very differently. That depends on industries and philosophies of firms and all this kind of stuff. So $10 to $50 million revenue, growth stage. And in that space, there is like the fact that very few of that angel companies get to a seed check. And then very few of that seed checks get to a Series A check, and then a few of that Series A checks come to a Series B check. And again, there is some data historically. So the earlier stage, the graduation rate, so to speak, is historically around 30%. That means 30% of the angels get a seed, 30% of the seeds get an A.
Which is not
And
bad.
when,
I was
yeah,
expecting
which is
it to
not
be
bad.
lower. Yeah.
Yeah, which is actually what, again, funding had not been that difficult. And then obviously there are times if you take the same data for a year like 2008, which is like terrible, you'd probably see even not even like 5% making it to the next level, right? So vintages matter quite a lot. I'm talking about recent history.
Okay.
And then, so that is actually the reason why by the time you get to a growth stage, like, maybe only a small percentage, maybe 20% of the people who got a angel check actually are in a position to even fight for a growth check. Now, when it comes to growth, unfortunately, and again, this is not unnatural, just because all countries, etc., all our venture ecosystems goes through this process, where typically the people who have done well in growth have historically become late-stage investors. So they would have made their track record doing, say, $10 to $50 million revenue companies, but then investors have given them way more capital, and then they went into the business of investing into $75 million companies.
Okay.
Or
like Tiger Global would be an example.
Yeah, Tiger is an example, right? And Tiger is an example where they started as a pure growth firm, and then, obviously they had their public market business, which is separate. So they made a reason that, look, we understand public markets, we are better off investing later, but we'll also invest across the spectrum. There is also another thing which happened where you take a Sequoia, Axel, Lightspeed, etc., or General Catalyst, all these firms. They used to do early stage, then they started doing growth stage also with their growth stage funds to back their own companies and then do new investments. But again, sometimes these things ebb and flow. What I really mean is that if the market is actually putting a lot of capital to work, especially LPs are very happy in opening the first checks, then there is a lot of capital which comes into the growth stage. But then when the market becomes tighter, they all tend to, hey, we want to be that first check in a company, which is basically their bread and butter, their super core part of their business. And growth is actually an extension of their business from that perspective. For many of them, I'm not saying, again, there are people for who have completely moved from early to, hey, growth is my core, etc. But that's actually the entire landscape. Very specifically coming to India, look, we had a lot of hedge funds who used to write growth stage checks. Almost all of them, if not all of them, are actually out of the market. Maybe one or two of them still write a check once in a while.
These would be like, say, Motilal Oswal, these kind of
no, hedge funds are like, I'm talking about Tiger, I'm talking about Tiger Cubs, a few of them were active in India. There's a fund called StateView who's still active in India. They still write a few checks, but less number of checks than what it used to be. So folks like that is actually what I'm talking about. So they came from hedge fund world. Motilal Oswal and all are private equity funds. Now, we do see recently more and more private equity stepping into the growth stage venture. In fact, today morning, I was having a conversation with a private equity veteran who congratulated us for a recent investment. And he said, hey, look, we saw this company. We really like the founder and what they're building. But they're at that stage where they're not like steady state EBITDA, where I can value them on a multiple of EBITDA. And that's actually the reality. So because many people think, I can go to private equity for a real tech growth company, like in a growth stage tech company. Unfortunately, the answer is only very few growth stage tech companies actually fit the, I would say, sandbox of a private equity fund, where they want to see a particular...
I was asking you, what's the mandate of a PE firm?
So PE funds typically, and again, I'm saying typically because it's 80-20 rule, there'll be always 20% of that. PE funds typically want to see a business model very settled with profit margins being settled. They don't want to kind of go in a company which says, hey, we're just breaking even, but we'll make 20% EBITDA 5 years down the line. That's a kind of risk they are typically not interested in taking. Nothing right or wrong in that. That's not their business, right? Number two, many times when they see a company which is $20 million revenue in tech versus say $20 million revenue in traditional manufacturing. In traditional manufacturing, you can say that, hey, this team is well set and it is like, this is exactly the team which is going to take this company from 20 million to a 200 million revenue. And it's all set. These people must have been industry veterans who came in 20, 25 years experience, etc. Versus the kind of tech growth businesses which we see, and these are typically backed by VC funds before, these are typically still founder-led. They may have, say, for example, their first product already in the market and making profits, but they're plowing that profits back into maybe the second product or growing a new market. Like, they want to come to Middle East, or they are good in North India, they want to get into South India, like West India, things like that. So this becomes a very different mandate than private equity, where I want established management teams and steady businesses with steady profits. Where here there is still a lot of experimentation going on. Yes, one part of the business would be stable, but we are still out there to take risk, to scale the business faster, better, higher.
Okay, got it. So you were talking of why growth stage funds are much lesser than early stage and late stage. And from what I understand, late stage funds were at one point of time growth stage funds, and as they started getting more investor funds, they had no choice but to become late stage funds, and which is why funds that remain growth focused funds are few and far between. And a lot of growth stage funds are also more early stage focused. They also do growth, but the primary goal is early stage focus.
Exactly. Like pure play growth is actually very difficult. Like there are very few people who do that because of the reasons which I mentioned. And by the way, there is an example in early stage in US VC I can explain. Is Benchmark, right? They have been well known for a firm who have stayed with a $500-600 million fund size for a very long time when their peers have actually scaled up much large, and they still remain the best in their game. Similarly is actually an approach, because in growth, if you really want to become, I would say, the number one firm in growth, where you're consistently good at picking these companies that say 10 to 25 million revenue and then scaling them to 100 to 200 million revenue, you only have so much of time in your hand. You cannot go and look at, if you're in the early stage business, you're looking at probably 4,000 companies. Versus if you're in our business, you're looking at only 400 companies in a year, right? So if you do both, suddenly you know how the time will become an issue for you. If you are in late stage, you are really going into, say, for example, you're investing, somebody like us, try to invest a 25 million check into a $750 million company. Our ownership will be so small, we'll not be in the board. We can't drive the outcomes of the companies. Then again, you're actually, in the other end, you're literally what we call as you're buying a ticket in a bus for a ride, right? And if the bus gets to the destination, you're good, but you're not really part of that team which is actually driving the bus. You're and I'm not again saying that as an investor, you're not the driver, but you're actually part of the navigation team. And you got to be part of the navigation team rather than just a ticket on the bus sitting in the back and enjoying the ride. That is actually the reason why doing pure play is actually hard, because it need a lot of discipline in number of companies, the work you do, etc.
What do you mean by discipline here? Like in terms of discipline of saying no to LPs if you're getting too much money, or discipline of saying no to, like what is this? Discipline typically means saying no, right? So what are the things you say no to?
Yeah, discipline typically means we have a saying like, you sit around and you say that's an absolutely great idea, but we are not going to do it. Right? Okay. That is actually discipline, right? Because that is something for somebody else to do. It may sound crazy, but here's the thing. One part of discipline is our business. Due to multiple reasons, there's a lot of capital available. So providers of capital always want to provide, if somebody's proven, want to provide them more capital. And many industry veterans would say, hey, look, If you're getting a lot more capital, you have to figure out a way, because your capital providers are your clients, to deploy that capital rather than be pure play and say, hey, this is the craft which you're best at. And we are not going to be in that craft of putting that $25 million check in the $750 million value company and being in the right. So that is one aspect, like literally saying no to money. That's number one. Number two is actually we actually spend a ton of time, literally, I would say, agonizing sometimes about when we look at a company, can we really bring real value to the company than money? Because that is the only place where you really can build a partnership with the founders, right? Where the founder comes and literally calls you at like 2 a.m. in the morning. When they have a problem, they would be actually brainstorming, and they're like, you are at sleep, and then they wake you up for, hey, we have a problem, and you are the trusted partner. We want to talk to you. Right? If you want to be in that position, you really are not just bringing money. Money is just a commodity. Right? And so you stay disciplined on, hey, here are of the 400 companies we do look in a year. We call it as a 444 process. 40 companies where we go in and really understand the business to the next level. And how we pick the 40 is pretty simple. We look at founders who have got experience, either building that business itself. And they think about, we look at like, have they gone through a near-death experience? What have they learned? Have they just dropped the thing and gone? Or have they actually really fought the situation and really gotten over that, etc.? These are all the things which you look for. Or maybe they have done that in a previous business or previous job, something of similar nature. And then we look at large markets, because ultimately, whatever you do, large markets are important. So when we look at large markets defined as 5 billion plus markets and experienced founders who have gone through the journey, we pick 40 of them every year and then go deep with these 40 companies, really understanding, hey, what are they really building? And ultimately with a lens of what can we bring to table for these founders, where they would probably 5-6 years down the line after working with us, think of us more in the side of a co-founder rather than the side of an investor. Right? And that's a very important thing for us to so that is a part of discipline that I'm talking about. Now we are really putting, sometimes people say, you're putting too much of pressure on yourself to be, because it's very difficult to be of genuine value to a founder who is really best at their craft, right? But that's a thing. So there are many deals where we looked at a company and we said, hey, look, great company, great founder, great market, probably would become a great outcome, but there's nothing much we can bring to table here. So let's just move on, because we would be just, again, practically buying a ticket, which we don't want to be doing.
The 400 to 40 process, besides TAM and founder, what and revenue, you told me you're looking at 10 billion plus ARR. Besides these three, are there other numbers that you look at?
Yeah, there are definitely other numbers. So the way in which I'll take you through that process, right? And it's quite interesting. For everybody have their own unique soup for this, right? So it's not like our way is right and somebody else's way is wrong. What works for you, right? What works for us is this. What we call first, we start with founders or founding teams, which bring unique perspective to a large market. And are they really ambitious, right? These are three things, right? So unique perspective, large market, and ambition of the founders. Now, why each of these things are important? Unique perspective is important because many of the markets we are looking at, I'll just take an example. One of the areas we should go after is consumption, especially driven by women in India. Right? Now, there's a large market like jewelry, which we went after. And when we met Gaurav, who's a founder of Bluestone, previously backed by Axel, Gaurav had a view that, look, it's already a $60 billion market. So the market size is not a problem. But here is the issue. The new generation want more designs than the traditional designs which are available in the large jewelers. Now, there is a problem in this because the traditional jewelers always outsource manufacturing, which basically means that there are minimum order quantities. And you can't, you can't do so to speak, the fast fashion equivalent in jewelry by having like 5,000 designs and build a model to kind of like manufacture these things literally at single piece at a time. So for that, you have to really figure out manufacturing, and you have to figure out just-in-time manufacturing in gold jewelry, where you can get an order and make it within 24 hours and deliver it within 36 hours. That's a very tough problem to solve. But when he got that initial part of manufacturing right, that's when we funded him to then say, okay, fine. He had that insight that with this, I can actually give a very different customer experience which customer wants. That is unique designs, which is the young customers want. And then when we did our work, we said, hey, look, by the way, you're doing it only in e-commerce. You should do it offline also and make it omni-channel, because then you can build customer trust also along with that. So there is something which we brought to table also in that context, right? So what we try to look for is unique perspective which comes from the founders, and then there is something more which we can actually add. So that's a starting point when we go in. And then we look at, okay, fine, if that is the case, have the founder gone through that journey? Are they experienced? Yada, yada, those things get through. We go in and look at the market size. And by the way, market size is again an interesting question, because many times, again, it's a famous ice hockey player. I don't know who said that, but I'm not an ice hockey fan, but this quote stayed with me. You got to be where the puck is going to be, not where the puck is. Right? So that is very, very important. One of the key mistakes where I would say rookies in our industry makes is that when they look at TAM, they look at TAM of today. But when we sit down with a founder and really unpack their ambition, and that's where the ambition piece come into, what we really look at is not what the TAM is today, but if this founder do a bunch of the things which they want to do right, with their unique point of view, which they bring to a large industry, what can the TAM become? So that is the leap of faith, you can say, but we do take that after sitting down with, so for example, I'll tell you the case. Today I'm analyzing a company. I won't specifically talk about that because otherwise I may out the industry, etc. But it's a $35 billion TAM market as a larger market today. But this company is building something which is in the 2 billion sub of that. And the founder, when they talk to many people, they say, hey, look, many people have turned us down saying that our TAM is only 2 billion. But the way in which they are going after this particular thing, by product formulation to manufacturing to owning the supply chain to owning the distribution, they're like, look, I want to go for the 35. Today, it's impossible for somebody to see that. But here is my experience. Here is my co-founder's experience. We can go for the 35. And that 35, by the way, in the next 10 years will become probably 60. I don't know. So for us, we are actually playing for a 60 billion TAM. We are not playing for the 2 billion TAM. And we are playing on it with the founder. So that's the second piece which comes in. And then we do use that to filter the 400 to 40. And then we go into the next layer of numbers. So the next layer of numbers is actually this, right? And number one, which we focus quite a lot, is actually customer acquisition cost. And this again have numbers and non-numerical parts to it, because there's a lot of businesses which actually can be built on CAC, and they will last till the point of time the CAC overtake the LTV. Right, and we have seen that happening so many times, especially on online-only models in India. So we really like to see how the construction of CAC is actually done. Is it actually just only online, or are you actually building beyond online, etc.? I'm talking about consumer businesses. Whether it is enterprise businesses, then the CAC LTV math is much more better, easier for us to kind of look into and analyze and everything, because they tend to actually follow certain rules. In consumer, it's much more difficult. So we look at CAC, specific CAC itself, CAC payback period. And payback period is super important for us. We love companies which have less than 6 month payback period. Versus many times, we see people investing in something with a 3-year payback period, etc. again, in their scheme of things and their models, it will work. But why we like a faster 3 to 6 month payback period, if possible, because that means that the company is way more capital efficient. They can literally, like, it's like the old, I'll use an Indian word, baniya, who's like a traditional businessman who's running an operating business. They think about how fast I can cycle my money,
Yeah.
right? And it is very, very important for new age founders also to understand that concept. Because if you can cycle your money once in 2 years versus you can cycle your money once in 5 months or 6 months for acquiring and getting your money back from a particular customer, it makes a 4x difference, or sometimes even 5x difference in the amount of capital you raise, the amount of dilution you take, the ownership of that business. And this is without compromising on your growth. I'm not saying compromise on your growth, right? So we always look for businesses which has got a faster payback period. We always also index on good growth rates, and it could be anything from 50 to 100%. There are some businesses of ours which are growing 100% plus at that stage also, which is great. But we're not looking for like, hey, look, I want to see like 10x growth a year. Like, that's not the hockey stick that we are looking at. Again, there are people who are very good at focusing only on that. That's not our space. So we are actually okay to talk to founders who are growing 50, 60%, but want to build a profitable business. That's not a problem for us. Then another thing is gross margins. We focus quite a lot on that because in businesses like ours, or the stages where we enter, gross margins tend to be the best forward indicator of long-term profit margins. I'm not saying that all good gross margin business become all good profit after tax businesses. Obviously, you have to do the next level of work in stripping down everything and understanding other costs which come after that. But that gross margin is a great starting point for us to see. So if something is like, if you're a consumer business which is making 25% gross margin versus if you're a consumer business which is making 50% gross margin, we'll be very interested in the 50, the 25 will be very hard. Right. So that is the difference that we're talking about. And the last thing, these are some of the major things, like you can again go unpack into the next level. But the last major thing which we look at is, are we investing in leaky buckets? So I'll give an example. So we recently invested in a company called Flip Spaces because we really like this entire space of India is having, people are building houses, companies are building offices, so much of construction is actually happening, right? And these guys are they are actually a company which do the interiors for offices. But why we did not go into that space for individual real estate, people like you and me building a house versus a Tata building an office. You and me will do a house only probably once in 10 or 15 or 20 years, right? And our renewals are also even if you renew the house, it's not going to be that often. Plus, our asks are almost always very bespoke, right? So versus enterprises, you do a good job for them. They are always making an office. They're always making changes in office every 3 years. You have a consistent business. So we don't want to be one-time businesses. We want to be in repeat businesses. And if we look at businesses quite a lot to see whether, hey, is this a customer which you can acquire and repeat over and over and not lose them? Do you have a history of not losing these customers? You may lost 2-3% probably, but preferably we prefer what we call as net negative churn. That means your existing customers actually have provided you more than 1x of last year's revenue from that cohort.
Okay. So you would have never invested in a live space? That's
interesting. Listen, we have evaluated. Look, they are again building a great business, but due to some of these things, I have a lot of respect for the founders. We looked at that entire space of live spaces, home lane, etc., but decided to go into the enterprise side of that business rather than the consumer side.
Okay. I'm just curious. What do you think? India has some 100+ unicorns. How many of them are fairly valuated? They actually deserve that valuation, and how many are yet to grow into that valuation? Just like, rough estimate.
I would more like say 70-30.
So
I know
30% are yet to
yeah,
grow into it.
30% are yet to is what I may not be. I may get a lot of hate mails after this probably, but that's what I actually feel. And let me actually explain why I gave that answer. And because obviously the founders would think they are worth that much. Their investors also may think they're worth that much. But the reality is, you would see the public markets. And look, we have taken a company public, the two companies public recently. We're taking another public later
Which
part of this
ones?
year. So we have taken Vyome and Bluestone public in July and August of this year. We'll be taking one more other company which is filed for IPO is Cure Foods. So once we get the approvals, obviously it'll go public. And we have other companies in our portfolio which will be looking to go public next year, etc. So when we talk to the public markets, they actually have a different view of how much these companies are worth. Again, I'm not saying their view is right or somebody else. But the reality is like, look, the largest mutual funds believe that many of these companies are going to be worth for their listing a small to meaningful discount to their last private valuations. The reality is that they are the anchor investors for that public market round. That is what they're willing to pay. Your valuation is that, right? Or you can spend another 2 or 3 years more, grow into what they think is that valuation. So it is, my comment is coming directly from where the public markets are willing to value it from. Part of this thing about the public markets opinion is also from, because in the first generation of Indian tech companies which went public, they said, oh, okay, fine, I'm trusting all these things. These companies are going to immediately hit profitability. They're going to throw a lot of cash out for us. Unfortunately, that has not happened. Again, from the founder's point of view, it may be the right thing because they want to reinvest in growth, which is what they will do with people like us, right? We would say like, hey, look, we understand we are focused on the eventual outcome. We are okay you not making PAT this year. But public markets don't operate like that. They want to see if you're gone to them and said, hey, look, we will make profits in 2 quarters, you better do that. Otherwise, they won't trust you. And that's a problem. So there is a little bit of a trust deficit which need to be bridged today. But on the same time, public markets say like the way to bridge it is come with a good valuation and let's just all build together so that I'm not paying you a high valuation upfront.
How do you decide when a company is ready for public market? Like say Bluestone, did Bluestone also go for late stage funding, or did they straight away go to public markets?
They did some late stage funding. So they raised a couple of $100 million rounds before they went public in the 18 months in the run up to go public.
Okay.
And that's always useful, right? Because there are some times in which some reasons why this happens is to clean up the cap table, consolidate the cap table, etc., before going public to avoid selling pressures and things like that in the public markets. But to answer your question, how do we decide? It depends on the companies very specifically. Ultimately, that decision lies with the board and the founders. Some founders would decide, like, look, we have a founder who is deciding to go take the company public within 5 years of its existence because he's like, look, I've already become profitable, one thing. And he said, look, I am better off building this as a public company because I want to build a very large business in my space and the cheapest capital available. If I'm very confident of delivering what I will say I will deliver with profitability, the cheapest capital then is available in the public markets, which is actually the truth. Because if you do well, if you say what you do, the public market actually rewards you for that, right? And somebody is confident of that, they would want to go public early. So some of the profitable companies, actually, I believe in India, would go public earlier and create a lot of wealth in the public markets. Versus some others would say, hey, look, I want to reinvest my capital and grow faster. I want to kind of really get bulky in private markets. Without that quarter by quarter public scrutiny, I'm not ready for that. My company is not ready for that. My management team is not ready for that. In which case, probably they could, even if early investors, etc., want an exit or something, there's always other mechanisms where late stage investors can buy them, things like that. and they would stay private. Lenskart is an example. Right? They have stayed private for a very long time to a very large scale
Right.
before they go public.
And I think they've been profitable for quite some time also as well.
Yeah, that's correct. That's correct.
Okay, interesting.
Again, no right or wrong answer. It depends on the company's specific needs.
Yeah. So, what is the difference between a late stage investor and a PE investor? Is it that PEs want a bigger stake? Is that the difference, or?
Look, some of these lines blur. I have to kind of give that. But that being said, typically, if you think about a late stage investor who's focused on tech and large outcomes, they could be obviously SoftBank comes as an example. Tiger Global, when they were actively investing, comes as an example. There are people like General Capitalist, who is very actively investing today, comes as an example. They are willing to actually still take risk and say, hey, look, we are happy to reinvest on growth. A lot of the capital, right? Rather than, so they would be actually happy saying, hey, the company is today just broken even to EBITDA. I'm happy to kind of stay at that just broken even stage. Versus when you talk about private equity, they come with two things. One is typically they want more profit visibility, or profit already have happened. Or they are like, okay, fine, now the profit is coming through. I want that, 2% EBITDA going to 20% EBITDA sooner rather than later. So that this become a very steady business, so to speak. Second is private equity tend to be very conscious, usually, about what percentage ownership they have. They want to have meaningful ownership, or ideally even controlling ownership of the businesses, which is the second thing, which is very tough sometimes in India, especially the controlling ownership.
Because a lot of businesses are family owned and
traditional businesses, family owned, all that kind of stuff. But in the tech and growth stage tech kind of scenarios, like buying 50% of a company, unless like a large part of the existing investors are willing to sell to a private equity. And there are certain situations where that happens, but it is very difficult because many of them want to kind of get that large outcome. Because if you think about it, say, for example, I'm just picking a name, Axel have invested in their company at a Series A stage. And that company have done quite well. They're today at, say, 800 million value. Axel believe that this could eventually become a $2 billion company in the next 5 years. Yes, they may have been in that company for the last 6-7 years, but they have their LPs allow them to hold that time, right? And this could be a needle-moving outcome at $2 billion for Axel. Now, why would Axel sell to, say, KKR today at 800 million valuation, all their shares or majority of their shares? Unless the founder says like, hey, look, this is what we want. And I have a ton of respect for the folks in Axel. They would do what is best for the company. Unless any of those kind of scenarios, they would want to kind of play for the upside, because actually the business is about also, especially the early stage venture folks, it's about creating the big outcomes. It's not about just making a 5x in a deal and getting out or something like that.
Okay. What is the source of capital for each of these stages? Like, I believe a lot of not growth stage, but a lot of early stage capital is domestic LPs today in India. A lot of family offices are going into the growth, into the early stage investing. What about growth stage, late stage? How much comes from domestic? How much is international, global LPs? Where do you raise your money from?
So I'll answer where do we raise our money last. But typically, look, early stage capital globally, and I'll come specifically to India, it comes from either, in the institution side, it comes either from endowments and foundations who have the appetite for building programs around that and who have done it well. Typically in the US, these endowments and foundations. Or it is family offices who have, again, the risk appetite for doing this, right? So that is the two buckets of capital who have historically funded the, I would say, angel seed Series A funds, historically. When it comes to growth stage and even late stage, you would still see endowments and foundations somehow, or larger families probably. And typically, I would say larger institutionalized families who have a team running the program rather than the family individual running it or something like that. But we also have other institutions, say, for example, fund of funds stepping into it. We have some small insurance companies sometimes stepping into it, small pensions stepping into it, and some other form of institutions like multifamily offices, etc., also stepping into that space. And when you come to late stage, obviously, all big institutions like your sovereign wealth funds, your large pensions, all of them are okay to the late stage funds. Now, coming specifically to India, there are, say, for example, domestic Indian funds. I take an example of a Bloom or a Stellaris, etc. Most of their capital come from global institutions or global family offices. And so they have a good global LP base because they have multiple vintages. I think Bloom is now raising Fund 4. So they have multiple vintages. They have that track record. Stellaris team came with their track record from previous firms, so LPs were comfortable backing them. So that happens. So they would be more indexed towards global LPs, but with enough of domestic LPs also backing them. Right? So it's a mix of that. But if you are a newer firm which is going to start off, right, the Karthik equivalent who is coming out, like Karthik started Bloom in 2012 with Sanjay and Ashish. So if they are trying to start it today, probably they would find more of that money from domestic LPs for their first fund or even second fund before the global LPs start investing in them, because the global LPs have already picked like a Bloom or an India Quotient or a Stellaris, etc. Right? It's not that first generation is already created. They have picked their bets. So the next generation will have to work more harder to get their money to an extent. When it comes to growth stage funds like us, capital is primarily, while there is enough capital still available domestically also, again, I think it's the same situation like a Bloom and Stellaris. People like us, for example, 75-80% of our capital come from global markets, actually, global institutions. Primarily, it's US and Europe, even though our latest fund, we have seen capital coming from Japanese institutions, Korean institutions, Singaporean institutions, etc. Asia Pac is also opening up significantly for people like us. But generally, again, there is a lot of capital available in India, domestic market, institutions and large families to back growth stage funds. Late stage, unless you're a proper private equity fund where there is domestic institutional capital, most of the capital is actually global. Like say, you think about Chris Capital, Kedara Multiples, most of their LPs are actually global LPs. They also have domestic LPs, but I would take a guess, I hope it is right, that 90% of their LPs are global institutions.
Okay. Who are the, like India doesn't have endowments or even pension funds putting money into private investments, right? So who are the big check writers? Like you said, institutional money.
Yeah.
Like what kind of institutions?
So there are 2-3 forms of institutions. I'll start with the government fund of funds. So SIDBI runs a program, SRI runs a program. So that is one. And government has done a great job of actually providing that capital, I would say seed capital to fund managers, right? So that's great. The second set of institutional capital in India is insurance and banks. Now, there was a RBI regulation which came in, and now things are actually being cleared up for banks to invest in private equity funds with certain riders on board. But insurance and banks, those two buckets are actually open. And there is, I would say, it won't be like, it probably will be a dozen to 15 names which are there, but that is actually still significant number to go around. And some of them have meaningful ability. Like when I was with the CIO, he said, like, look, a fund like yours, we can write a $25 million check. That's not small. Right? So these are significant check writers. They could be what we call as an anchor LP for funds like us. Then there is, I would say, institutionalized family office. Premji is an example. Catamaran is an example. Folks like that. I think almost all of the Infosys founders have their own institutionalized family offices now. So that's one example. There are a few other Indian families also who are institutionalizing their family offices, which we have seen. They again have the capacity to write anything from $5 to $20 million checks for fund managers whom they really like. And many of them are also understanding that, look, we have to focus our relationships rather than writing too many small checks. So that's the other institutional pool of capital. Like, say, for example, Azim Premji Foundations, we talked about, do India have foundations and endowments? Azim Premji Foundation is actually a proper foundation which invests in funds. And Lan, who's the CIO, does a phenomenal job of running that firm. There is, I think, IIT Delhi, or all the IITs together now have a endowment in place. It's not a large endowment, but still that's actually a good start. So we are seeing the first, green shoots of some of these endowments and foundations getting created in India, and managing capital in a proper way also happening in India. Then when you go to larger institutions, you go to the pensions, etc. Today, they're not really looking at many of these things due to regulatory bottlenecks. But I think those things will also, if you think about government linked, like LIC in that insurance bucket is already investing in private equity, right? But can an EPF invest in private equity? These are things which I think government will have to look after. But at some point of time, these buckets will also open up for fund managers.
I think in the US, they're opening up more capital sources for private equity, right? I think that their retirement, the 401k plan, I believe,
401k,
is what it's
yeah.
called, there is now allowed to invest in private equity as well.
Yeah.
So you are hoping for similar changes in India as well too?
Yeah, I want to kind of caveat this though. Look, what US is specifically doing is actually telling that you're a retail investor and you can actually invest into private equity, which is a very sophisticated asset class, by doing your own direct allocation.
Okay.
You're picking you're buying an Apple stock, you can actually now tomorrow go and invest in XYZ private equity fund. I personally, and again, this could be something where I can get bad karma from the industry, but I personally don't believe that is a good idea, right? I think retail investors who would have many, they don't understand the liquidity constraint of our industry. You're pretty much locking away your capital for 10 years. There is significant risk that you're taking in many of this. If you invest in a fund like ours or Bloom or anything, you're actually probably investing in an extreme end of risk spectrum. Many people don't understand that. At an individual investor level, you need sophisticated allocators to do that. So I would personally think, yes, if a professional team inside an EPF making an allocation on behalf of millions of their contributors, yes, that's definitely something which can be done and which should be done, because they deserve a allocation to the growth which is happening in India in the private space, which today they don't have any exposure to, right? So that's the right thing to do. But giving that, literally asking a school teacher to write a direct check to Iron Pillar or something, I will not, my mom was a school teacher and I know I will not sleep well if that happens, right? And I will not take that money. It's dangerous for them, because they may need a medical need tomorrow and they may need that money, and how do they access it? That's the issue. One other pool of capital which is also happening in India, which I forgot about the institution side. We also have private fund of funds. So, for example, Nippon have one. We have firms like Oyster Global who are actually starting up private fund of funds. Quasi-private public, NIF. So that is another pool of institutional capital which is again coming up in India, which is important to mention.
Okay, so this private fund of fund is essentially aggregating family offices, money, and
no, many of them are actually institutional capital. Some of them could be family offices, but if you look at Nippon, for example, all their capital, my understanding, come from institutions in Japan. NIF, their capital come again from global institutions.
Got it. In general, what's the pitch for investing in doing private investment, or in that this whole venture as an asset class? What is the pitch for that?
Look, if you look at India today, this is how we see India today, right? So we have around $2,900 per capita income, depending on where rupee is today, right? And it moves up or down. If you look at US as a developed market, it was at the same stage in 1959. And if you take 10 years before that, US grew per capita income almost 60%. And this is post-war, boom, like all that positive thing, right? India almost doubled it in the last decade. So you can first of all see, like we are coming off like very strong tailwinds already in our back, number one. Number two, we're the fastest growing economy in the world in this decade every single year, and expected to be the same rest of every single year in this decade. Now, you add that to the third part, which actually people talk very less about. Many countries, like, which when they went through, like you take the North Asian countries, Korea, China, etc., or like even Japan, when they went through their growth, they all grew with exports and infrastructure builds as their key engines for growth. That was giving anything from 60 to 70 or even 75% of their growth. India's 60% of the growth is actually coming from domestic private consumption, right? It could be companies, it could be B2C or B2B2C, right? That domestic private consumption. So that's the lens which you took at, and that's why I mentioned US, because US in 1959 and even today is almost 60% domestic growth. So to an extent, the golden ages of US was created by US building for US, because they have a big domestic industry which actually supply for their own consumers, and that market is large enough so that they build economies of scale. And then once you build economies of scale, you actually can win beyond your country also, right? That is a simple playbook. And for that playbook to happen, you need to have a big domestic market to start with. US had that in 59, 60s, etc., and continued to have it. India had that today, and India will continue to have it. So now, if that is actually the premise that you're looking after, and then again, I think it's the right thing that the government is focusing on manufacturing domestically for domestic consumption, right? If we kick off that flywheel that we're making in India for India's own consumption, and we're building big scaled companies with world's largest population on our back, obviously, like we consider today's real consumption class in India is only 50 million people. Many people will say that's 250, etc. We think that probably their math is wrong. There's really 50 million people who are really spending, but that'll become 150 in the next decade. That's one of the largest markets in the world. Right? So then you have a big market to cater to. Now, coming to your question, with this market and this tailwind of we building for ourselves and building scale, why privates is because some of the best founders, as you've seen, you want to catch them early. Like if the McDonald's of India is getting created, if the next biggest insurance company of India is getting created, the next color cosmetics company, the Revlon of India or Estee Lauder of India is getting created. Like all these things are going to be created in, we think that whatever is already there is going to be the next big companies. No, 10, 15 years down the line, many of the titans of today will be number two, and some smart young entrepreneurs with that unique insight in a large industry is going to build large companies. People like Gaurav and Ankit, etc., are building that. And it is a shame that a large part of investors don't get access to these great companies when they are private, when they are small, when they are practically valued at a much lower valuation, rather than picking that up only in public market when these companies are valued in billions. And the pricing is pretty much figured to perfection, because the problem with Indian public markets, and this continues to be the same problem, I don't think it's going to change, the valuations are very high, and it always remain high. Like I've heard this for 20 years, and probably I will hear this for next 20 years. So the question in private markets is enter early, grow with these founders, capture the early growth so that you can create alpha, rather than you just create public market beta.
So you're essentially saying that venture as an asset class will outperform uh, mutual fund or whatever. If you invest in an index fund compared to that, venture as an asset class will outperform it. Uh, but I believe 90% of VCs don't beat an index fund if you look at last 10 years.
That is
I'm saying
true.
this anecdotally. I've heard from other people I've interviewed. But so what's your take on this?
No, great question, actually. In fact, I would recommend a paper to read. We have found our enemy, and it is ourselves. And this is actually, this is, you can go and search that. This is done by a famous institute which work with VC, etc. And literally they said, like, look, what we are preaching, we have a problem in this, right? And what really means, if the gist of that paper, which is actually the fundamental of what you just mentioned, is in venture capital and technology investing, a disproportionate amount of upside is actually captured by probably the top 20 players in any market, right? So if you want to be creating alpha in that market, you better have allocation to that. Like, you better should be able to identify who are that top 20, and you need to get also allocation to that top 20, which is also not always easy, right? And if you're not doing that, then you're better off buying an index fund. And by the way, the same thing goes to public market funds also, I would actually say. Like, if you really have ability to kind of access a fund like Renaissance Technologies, for example, in the US, any day, like, those guys every single year blow the index funds out of the water. And they've done it consistently for like 30 years or something till now, right? So, but then can you actually access a RenTech? Right? Probably you can't, because even biggest institutions cannot. So ultimately, even in public markets and private markets like ours, what is not really said is, like, if you are, first of all, like, even if you're not in top quartile, it's not even worth playing the game. Right? That's very, very clear. And you have to define the top quartile in TVPI, in net IRR, and DPI, all three metrics. You have to actually hit it in all three metrics. And then you need to be in the top 20 in that game. Then only you would be able to, like, it is worth. So if you're an investor, I would just say that, like, and if you're an investor like us, our job is actually to be in that top 20 in our game, whatever game. If you're a growth stage, you have to be in that. If you're an early stage, you have to be in that. If you're a late stage, you have to be in that. And if you are a investor who's looking to invest in our funds, the ask should be like, hey, look, how much have you actually outperformed the indexes? Probably the first question. But how much have you outperformed your peer set? And are you in that top 20, if not top 10?
Can you just define those three metrics you said on which funds should be measured? The IRR.
So three things, right? One is net IRR, which is the net money returned to investors after fee and carry, which is charged by the fund manager. So that this is the actual money. Like, if an investor invests a rupee with you, how many rupees you get back, or a dollar with you, how many dollars you get back after tax. Number two is TVPI, that is total value to paid in. So that means that you put that money, like the first one was IRR of it. This is the money multiple of total value of, like, when you put $1, you get $3 back, for example, which is a good number to actually on a net basis. An IRR good number would be like a 17-18% at least net for you to kind of take risk in market like India. And the third thing is DPI, because if you have your IRR and TVPI, but you're not still distributed the cash, it is still in paper, that is not good enough. Right? No, you have to actually have that consistent flow of returning the money back. Say, for example, we internally consider that in 7 years, we should return our money back to our investors. And in 10 to 12 years, we should actually sell everything, and, like, all our, like, return up stock have to be returned back as cash back to our investors. That is a good outcome that we benchmark ourselves against.
And what's the full form of DPI?
Distributions to paid in. Paid in is like how much money have the investor paid to the fund, and the distribution obviously is the money gotten back from
Okay.
the fund.
Okay. Understood. How much have you raised so far? How many funds? What's been the size of each fund? Just take me through the Iron Pillar journey.
Yeah, so we have historically raised almost like $450 million of capital. This is in broadly three buckets of Fund 1, Fund 2, and then we have some co-investment buckets. So Fund 1 is together, it's around 138. This is a fund and a top-up fund that we raised. And then we have Fund 2 is 214, which is again, we have an offshore and onshore vehicle. Specifically, the onshore vehicle is 84 million and offshore vehicle is 129 million. Again, onshore vehicle is not just Indian LPs, it's also have global LPs inside that. Most of it is actually global LPs there also. And then the rest of the capital, I would say it's around 100 million-ish or something, is co-investment pools, where some of our large LPs, they say, hey, look, some of these companies are great. We want to put our own money with you, but we'll take your help in managing that capital. So that's how we, our fundraising history.
How did you start Iron Pillar? Like what's the origin story of Iron Pillar by itself?
Yeah, it's quite interesting, right? So some of it is personal. So I was investing in China before this. So I started my venture capital history I was part of the Sequoia India team. When Sequoia came to India, 06 to 08, India was subscale at that point of time. So went to my partners in the firm and said, hey guys, where can I learn scale? Due to a set of events, I ended up actually moving to China because I figured that what is happening in China at that time could be something. 2007 is when China was at that same around $3,000 per capita income where India is today. Right? So I was like, hey, look, next decade I can learn things here, which I can probably apply in India. And that's the entire thesis where I moved to Hong Kong, worked for a firm called Squadron, which had third-party money and also their own family office. This is a big family office, plus third-party capital. Invested in China, across Asia, even global tech. And then in 2012, Squadron got sold, and I joined a firm called Morgan Creek, which used to invest in tech growth. Like literally what we are doing in India today, Morgan Creek used to do that a lot in China. And I moved to Shanghai. And at that point of time, so one of the things which happened is 2011-ish is the time when Tiger, etc., started actively investing in India in growth stage companies. And we started 2014, we started 4G came in, data became cheaper. The market started really evolving to the next stage. We even started some SaaS companies in India getting to scale like Zoho. So we said, hey, look, this is probably the right time to kind of start a fund which is very specifically focused on just growth capital investments in India. Now, why did we pick growth capital? We could have done another early stage fund. We could have done a late stage vehicle. Why we did growth capital? One is because this is actually a craft. Because many times we saw even managers, we talked to some of the best early stage funds. By the way, when I was in Morgan Creek, I was a first check into Bloom's fund, first check into K Capital fund. So we have seen that ecosystem of early stage growing. And many of them were getting into a wall. When they come to a Series B, Series C stage, they're like, there's no one firm which do only this. And why you need a few firms which do only this is because the skill set needed at that stage is very different than early stage. Early stage, you are actually taking a binary call on a founder and a market, right? Versus when it comes to our stage, yes, we will look at that, but then very soon we'll get into that 444 process of what do the company need for the next layer? Can we bring that network and relationships to the table? So we need somebody who actually thinks only of, hey, here is a $10 million company. How do we make it a $100 million company? Right? I'm only focusing on that and bringing global network and relationships, because what is needed at that stage, that is actually the stage where founders literally start looking beyond their teams. They're like, hey, look, I want to do A, B, and C. I want to go from a Delhi only company to Delhi plus Mumbai plus Bangalore. I want to probably grow my team. I want to probably position myself well with late stage investors. So there is so many such questions coming. And if you're an early stage fund who's investing in 12 companies every year, they don't have the time to spend on it. So that's the reason why that gap kind of existed. And we said, hey, we'll go and fill the gap. And then when we thought about filling the gap, then the question is like, how do we differentiate ourselves? Like, if we sit just in Bangalore and do the same thing that every early stage fund do in terms of our network, what we bring to table, we are like, hey, the early stage funds are doing already a great job of doing all that, right? What is needed in that early stage. No point. Let's bring the UAE network, the Singapore network, the US network, the London network to these companies so that they can get BD, GTM capital help to scale these businesses to the next level. That's why we started Iron Pillar. There is also a personal piece, which I said there is also professional and personal, the strategy. The personal piece is actually this, and this is something which I always found. So I was in Shanghai 2012 to 2015. All these global institutions come in, almost everybody pass through our office. And we talk about what are you seeing in the market, interesting things, etc. 95% of the conversation is actually about China. And if they feel charitable, and because I'm an Indian, there's a 5% conversation on India, right? And it's like, and the conversation invariably is like, when is India going to deliver, right? And you have that, and somebody said, look, you can do two things. One is you can actually join the complaining charade of people who would say, hey, like things are not working, yada, yada. What we decided, what me, Monjit, Ashok decided is like, hey, look, there is an interesting, different approach here. Let's go to the early stage funds, really see what are the challenges which are not building companies to scale. Can we figure out, let's build something which can help at least some of these companies. We are not saying that we can solve the market's problem. We invest in only 3 or 4 companies. But at least can we at least create a model where at least some of these companies can actually scale? And that will actually hopefully give a playbook for 5 other people like us to come and start other, what I would say as competing funds, to do something even better than us. Right? That's actually what, so that the entrepreneurial ecosystem in India ultimately benefits and all of us wins. So we thought that we'll rather do something about it rather than joining the group of people who say India won't work. So, and we're very thankful that we did it, because now many of our companies are going public, our LPs are happy, and the ecosystem is benefiting because of even our small contribution to that large ecosystem.
Is that question answered? When will India deliver? Because as you told me, a lot of late stage global funds have backed off. They're not so active in India anymore. So is that what's the answer to that?
Very interesting question. So my answer to people is this. Be very careful about, there are 2-3 things about India. If you think about a mental model, right? From that perspective. One is, what are you looking for from India? That is very important. And I'll come to what does that really mean. Because if you are coming today in India, which is a $3,000 per capita income, and try to see many hockey sticks, which are consistently going to give you $10 billion outcomes every year, you may be disappointed, right? Because it's just a function of where the market is today versus where it can be. It could be there in 5-7 years, but probably not today. That's number one. Number two, India is already delivering. If you really think about capital return, which is one of the biggest things which LPs think about, last 4.5 years, India has returned $135 billion of cash, hard cash, back to LPs. Wow. This has never happened in India's history. And not even a single year out of this 4.5 years is more than $40 billion of cash return. So it's not like 1 year skewing the numbers. I'm not doing statistics jugglery here, right? You have consistently seen good enough amount of money. And then again, another thing, almost every year of this, the maximum you would see public market contributing to this. So people think, oh, this is all public markets, right? No. Again, happy to share more data around this, but around 60% of the money is actually coming from public market, even in the best year. But rest is actually coming from M&As and private equity also, which is playing a large part too. So it's actually a well-balanced ecosystem also for exit. So India is already delivering if your expectations are actually more compounding. So the biggest mistake this comes to my third piece of that mental model. I've always seen people underestimating India on the long term and overestimating India on the short term.
Very interesting.
Right? This is a consistent problem, right? Now, if you're coming to India for miracles in 3 to 5 years, you're going to be disappointed. I can give it to you in writing, something which you can open in the cover after 5 years. But if you go so pessimistic on India on a 10-year time period, you're also going to be disappointed. Oh my God, I missed a great investment opportunity. So if you really build that into that thing, say for example, like a good friend of mine who's a very good macro thinker and he writes some good op-eds, etc. He always talk about this, when India grows under 7%, I always think, look, it is going to revert to the mean of 7%. But when India grows to 9%, when the world is like, yay, now it's actually the big time, next 5 years is going to be good, I will actually temper my expectations. It is going to come down to that 7 or max 7.5%. So you got to, and there are fundamental reasons, and economists may be a better person than me to kind of explain this to you, that our growth rate is going to be on a medium time, 7 to 7.5%. So every investment you do, you need to temper for that. Also, we don't have the best, the most hockey stick AI models getting built in India today. Well, maybe people will do something else somewhere else. Maybe we'll have some other areas like space tech where we'll make some really big leaps. But if your investment thesis is just based on that, you could get that short-term pullback. And that's actually the reason why people who thought about hockey sticks and came into India pull back. But people who have consistently invested in India have actually reaped rewards.
Okay, fascinating. What's your investment thesis in terms of sectors? Like, are you bullish on AI, for example? I know you're doing consumer because Bluestone we already discussed. But what all sectors do you actively look for opportunities in?
So we invest actually in the consumer and enterprise both. In fact, 70% of our investments are in enterprise tech. But that is actually split also into what we call as B2B2C, because many of those enterprise tech companies are an eventual play into consumption story. Like I talked about flip spaces, right? Ultimately, it is like India getting more offices, more people working as the economy grows, and more offices getting built. Or like a company like Servify, which is ultimately where people are buying mobile phones. You're selling to an Apple, but ultimately you get money when a customer buy an Apple phone, things like that. So coming back to the thesis, one big thing which we are underpinning, especially when you look at next 3 year going forward, is that India today is around $2.5 trillion domestic consumption economy. This is going to almost double, almost in 2.5 going to almost 4.4 trillion in the next decade, right? So that is 80% kind of growth. And this is a huge opportunity, both in direct-to-consumer and also the B2B2C kind of enterprise tech companies, which eventually play into the consumption thing, right? That is what we look into. Now, once we have that piece cleared, what we really look into at the next layer is which of these categories would be actually the biggest areas where we can go in, and we cannot focus on everything in the market, right? So we look at one theme which we have historically done and we'll continue to do is discretionary consumption, because as people go from say $3,000 per capita income to $5,000, a lot of that delta of 2,000 actually go into discretionary. So it's not probably discretionary consumption go by 4x or 5x in that time. So discretionary consumption, especially by women, is a category which we tend to like. Because these are categories where at this stage of countries' developments, big brands get created. Because women tend to actually be more experimental. They want to the young women of India today want to do things which are different than what their moms did, etc. Whether it is trying out a new jewelry, trying out makeup, trying out new kind of clothes, new kind of shoes, different things. That's number one. Number two is financial services. But I know there is a lot of focus on lending, which we have a problem with because they all end up being an NBFC. So you get a NBFC valuation in the end and you go in with a fintech valuation. But there is a multiple other things around savings, investments, insurance. There are many other categories of financial, because India is actually financializing, so to speak, like people's balance sheets are financializing. That's a big area which we focus on.
What's your fintech bet so far?
Servify is one, which has actually worked out very, very well for us. It's a B2B2C play, but they actually are a big insurtech play in the country. Okay. We invested into ToneTag, which is another company, which is again, they built out a protocol on top of UPI payment systems, which can reduce frauds and reduce drop-offs. And ultimately, we kind of compare them more like a MasterCard kind of. If you think about the business model, eventually that's actually what they will play out to be. So again, you need to kind of think about very tangential plays, but ultimately you make your money when people are making payments, right? But you're not selling directly to individuals. You're selling to banks and other financial institutions which want to kind of put their technology in retail spots. Another big area which we are really looking for is innovation in retail. So retail in India is actually going through a lot of changes. So think about it, who's going to build the Costco of India? Right? That's a question which we ask ourselves. Or what are interesting, very specific niche retail opportunities which can actually be built in the country, which can actually stand on their legs and not disrupted by quick commerce, things like that, etc. Or probably even benefit from the quick commerce trend, things like that. So we look into that. We look at another big theme which is actually happening in India, and again similar lifetime, that $3,000 to $5,000-$6,000 per capita income growth in the world is households upgrade. That's what so they upgrade from a two-wheeler to a four-wheeler maybe, or they upgrade to a better two-wheeler. They go from no air condition to one air condition. They upgrade from one aircon to three aircons in the house. They will have more gadgets inside the house. So stuff like that. That's actually a big area again, which we focus on. We actually focus on pollution as a theme, or I would just say environment. No, the fancy term to use is climate tech. But I think people kind of overuse it so much that I try not to use it. But we actually focus on environment because I actually have this view personally, and my partners also have the same view, that India 43 of the 50 most polluted cities in the world. A statistic which all of us would be ashamed of. Now, it also, if you say always invert like Charlie Munger, the other side of that is India have the opportunities to build because it is the largest market for cleaning up air, water, soil, you name it, whatever it is. It is the largest market for that. And somebody had to kind of go and do 0 to 1 innovation for India very specifically for that, because most of the technologies available for cleaning air or water or soil or anything like that today globally are too expensive for Indian companies to adopt. Right? So Chakra, which we just announced yesterday, is a great example. It's an air purification solution for large industries, which are huge pollutants. But the current technology available from Japan or Switzerland, etc., are extremely expensive, or German technologies. So now they have actually come out with a completely different material science solution, manufactured in India, innovated in India, manufactured in India for the Indian market at an Indian cost structure, which can eventually become a global company. So that's the kind of things which we look into. Many of these actually are B2B solutions. These are not B2C solutions. I know that. And the B2B side, we also look into, when you think about financial services, I told about the direct to consumer things, but also we look at the entire infrastructure. Say, for example, lending infrastructure. I don't know, hey, who is actually the software providers for all the lenders? You may not want to directly invest in the lender and take balance sheet exposure, but somebody who provides software for that entire space is actually an interesting space to go after. So things like that. So, but we have around 7, 8 themes which we kind of go after, and these are like 5, 6 of that which I just mentioned.
So, do you think the AI theme is a little bit overhyped currently? Like, there's a hype cycle around that?
Again, chance for hate mails. So, yeah, AI theme in our view, honestly, is overhyped at this point of time. But again, it's not unusual, right? There are hype cycles. Like, in fact, the other day, I actually saw like a report which said like Gartner hype cycle. Like literally, I'm like, wow, somebody have actually, Gartner have named it as a hype cycle, right? So there is stuff like this. So, and there is a reason why, and there are people who are very good at investing in hype cycle and making money for investors. So don't get me wrong in that also. Then you need to kind of literally invest in everything under the sun in that space. You know that even if you're writing 100 million check, there is a big chance of getting written off, but some 100 million check will actually deliver you $1 billion. You're okay. But a lot of money is going to get destroyed in the current AI hype cycle. It is not something where somebody like us who are like, hey, look, we are a fundamental investor, basically, who's like, there are a lot of low-hanging fruits where we can take companies from 10 to 100, 150 million, work very closely with the founders like a co-founder, really bring our global network to them. And in fact, due to the AI hype, what we see is like many founders whom we talk to who are really building fundamental business, they are building color cosmetics in India, food businesses in India, consumer businesses in India, basic enterprise technologies like Chakra or Flipspaces, etc. They're getting zero love from investors because they don't have AI. Or they may use AI in some part, but they're like, they're not an AI company. They're not an AI software which will show that. And they're like, hey, what we are seeing in the other side is we're getting better valuations ever in our entire life today.
Right.
In this relatively hot AI market, because non-AI companies are actually not getting the love, those founders are seeing that, look, I need to build a profitable compounding business because even my next round is not coming because I'm not AI or AI first. That being said, look, I'll give an example of one of our companies in the consumer space. They literally took down their marketing team, which is around 10 people or something, to 2 people because they are deploying AI at scale for marketing related stuff. So there is a lot of application of AI in consumer and enterprise businesses, which we currently have, which we are seeing, but it is just like a tool in our toolkit rather than these companies don't really go and pitch themselves as an AI company. In fact, some of those founders refuse to. They're like, look, we have a company, Fresh to Home. He had an AI based a system to kind of bid for real-time prices for fish of all things, right? So because India have around 1,400 coastal harbors where fish comes in the morning and he had to bid at real time. Human being cannot do that. So he had done this using an AI algorithm back in 2016. And they've got it patented, etc., back in 2019 itself. But they don't market themselves as an AI company. They are like, hey, look, we are a proteins company, right? So we started in fish, we went from that to chicken and now going into other things, and we're building a global business in that. Yes, AI is a tool for us in doing that. So AI growth will help a lot of our companies like that, but I don't think that is a theme where somebody like us find it interesting, because ultimately if you're buying a bunch of things which can have binary risk at an extremely high valuation, it's a very different ball game to play. That's not the ball game we play. We're not in that game.
Okay. I want to end with something of a lightning round. Not necessarily I don't necessarily need 5-second answers, but I want to give you some names and I want to hear your take on whether you would have invested in them or not. And let's assume for every company you are saying it's a great team. Goes without saying.
Okay.
Like,
And I hope I know all these companies. That's the only thing. Sometimes
I'm only going to use big names. Okay, so
yes.
Zepto.
Okay. No.
Why?
You want me to tell the reason also?
Yes.
Because it's again, we believe that Blinkit is better positioned in that space. We may be wrong.
You're bullish on the space, but you feel Blinkit is the horse to back.
Exactly.
Okay. And because retail, anyways, like new formats of retail is one of your thesis. Okay.
Yes, it's one of the theses. We have looked at the business. That's the reason why.
Okay. Misho?
Misho, interesting. Actually, they executed better than what we thought. And I would actually consider that as a miss from our side.
Why is it a good, or why was it a good opportunity? Like, what's the thesis there?
So look, social commerce have actually picked up faster than what people thought in India. Part of that is actually due to
is Misho really social commerce today? Isn't it like a?
It is actually use social commerce as the beachhead to kind of scale beyond what they originally started, right? So ultimately, the piece which we could not really pick is like we said, like, okay, fine, with COVID, etc., social commerce will become bigger. But that founders, so we made that mistake, right? And again, we thought of a TAM or like what they're attacking, but their ability to be agile and scale beyond what they started off with. Like, it's like the question of looking at an Uber like a taxi company versus much larger, right? So we made that mistake. Okay. And this is not the only company. There are other companies also we have made that mistake and we have missed some things.
Cred?
No, because I'm still trying to figure out what is the eventual business model.
Okay.
Because I think they are continuing to still pivot, and that is not a great founder, obviously, as you said, but there's still like some changes which is going on. We want to kind of have a decent idea when we enter where the business is actually, like which direction. So we call it as it's a mountain climbing journey. We don't want to know exactly every nook and corner, but are you climbing Mount Everest through north face, south face, east face, west face? Because we know some faces you cannot climb, right? But if you don't know that, that's a
challenge. Zetwork.
It's an interesting company. We have looked at that space quite a lot. We believe that eventual winners in some of those spaces would be very vertically focused. And Zetwork is actually doing across multiple verticals. Plus, for us, the challenge is also valuation always.
Vertically focused as in there would be, it's essentially like an asset-light manufacturing play. So
yeah, but like, look, would you go deep into pharma manufacturing versus would you go broad into five categories, right? So that's basically the question. Because manufacturing is an area where once you get to scale, you can build decent scale with good working capital and if you get access to good amount of money. But beyond that point, you need to really specialize, right? And that is our house view. Again, we could be wrong. The founders are in the job of proving people like us wrong.
Yeah.
But plus also, like, the valuation had been, in our view, for a business like that, like what would be the right valuation to pay versus what we could have probably invested in was a challenge.
Okay. Physics Wallah. That's my last one. Yeah.
Great company, actually. Miss, clearly. We think that it's a great set of founders. Westbridge did a phenomenal job of investing in the company at the right time and
why did you miss it?
Like, the right
what was the?
So it's again like it's one of those things where we just did not see the company. I'll be just very, very honest. And we don't see 100% of the companies. As I said,
right.
we look at only around 400 companies in a year. We came to know about the business only after the initial investment in the company happened. And to an extent, I think, I don't even know whether if you have seen it, because also it was kind of a time in which Westbridge invested when EdTech was going through a lot of upside and then it came down. So they also had the advantages. They also had the capital to kind of see the company through the tough times also, right? So maybe in hindsight, it would have been better for Physics Wallah to have like somebody like a Westbridge as an investor who could do that doubling down at scale in that company when they needed the money. A fund like ours won't have that capital.
Physics Wallah could have been an academy version 2, right? But
if they did not get the capital, so they had the right investor who could double down at the right time, which by the way, I think is superbly underappreciated, because if you have the right kind of investor, like, that's one of the reasons why Samir and Sandeep are people whom I respect a ton. If they really have conviction on a company, they actually back them, and they have a capital structure which allows them to back them through thick and thin. And we are all in that journey earlier. They have done that. I worked for them before when we were in Sequoia, and they were part of the same team. But they have that, I think 15-year head start before us. Hopefully in another 10 years, we'll be at that position where we have enough capital to double down, where we can come to a founder and say, hey, look, not only at the current round, or currently we can invest in one round or after. So we can bring up to, say, 50 million in a company, but we have to bring 150 million to a company to scale to the next level. And we see that kind of industries where that would be needed, where we say, hey, look, we're not the right partner, right? Because you will probably go through that journey and you don't want to be stuck with us for that. And this, by the way, is an interesting conversation with somebody like a Zepto also, where we would not have partnered with them for that reason also, because we'd like, this is going to take billions of capital. We can't provide that. And then why are we even trying to partner with this founder? Because this is not going to work.
The risk with Physics Wallah kind of businesses, which are like one-star founder, like say An Academy, Byju's, is corporate governance, right? Like how would you prevent corporate governance issues from cropping up when there is so much reliance on one single founder?
Yeah, no, it's a great question, and this is something which is not only in India, many other markets also, this is actually played out. So 2-3 things which you do. So first of all, thank God till now we don't have any similar issues in our portfolio. What we have done is we focus quite a lot actually on companies having a proper CFO who reports to the board. Either they are already there in the company, or when we go in, we try to get them in. Right? And many of our companies, we actually have that done, which have helped the founders quite a lot. And there are many situations where we go and have a conversation with the founder, and founder completely disagree with this. And we say, then this doesn't work, we will walk away, which is fine. And again, there are founders who are completely disagreed with us on this and still go and executed phenomenally. But we don't want to be in that. So we know what is our sandbox which works, right? So we don't want to play outside that sandbox. So corporate governance, that is one. So finance being streamlined. In fact, as we speak, literally this month, we are giving offer letter to a veteran banker, somebody who have been around 20 years in the banking industry in India, who's going to come in and really help all our portfolio companies in finance to the next level. Like his only job is going to be this, right? Making sure that numbers are okay, audits are okay. And also he will bring again, like in our typical case, it's not just checking on you. Like this is somebody who have done debt underwriting for 20 years. He would actually help each of these companies. You want to make your balance sheet better. You want to kind of get all your banking relationships in order. We will help you. Like you don't have to pay somebody else for that, right? So that's what we do. So that's one aspect. The entire finance function is what you are seeing. Is it real? Right? That's very important for us. Number 2, which we do off and on, and nowadays we do more and more often, independent board members very early in the companies. And real independent board members. It's not like independent for the name of it, right? So we have done that in multiple companies. And that also really helps in getting it. But look, the crossing point on that particular thing is like, you really, the 40 companies, like 444 process, that 40 companies we engage, some of these companies we engage with these founders for 6-7 years. I know it may sound crazy because we know them when they started the business, but they got to our scale only. And many times we really think about, hey, have the founder and founding team taken the right decision rather than have they optimized to themselves in any point of time. And if we see the latter, we disengage. Because then we see that as a red flag. And that red flag, when you go to public markets, become an even more bigger red flag. And the public markets are very good in finding these things out. And once you create a bad reputation, the stock tanks and never comes up. Versus if you create a good reputation, think about why Tata always trade at a premium. any business of them, right? Because of better corporate governance. So we try to really, hey, is this a founder and founding team who genuinely understand that really good corporate governance, even like sometimes like really thinking about ESG properly. These are all things which are important on a long term for a company. If you really want to build a big company, right? And your customers care for it, your investors care for it, your employees care for it, all your stakeholders care for it. So are you really building a company in the right way? Then putting a CFO, putting an independent board member, etc., should be a natural conversation which will say absolutely yes. We want founders who say absolutely yes to that genuinely, rather than saying, oh, I may do that, this thing. I don't think I want a CFO. I'll hire a CFO before my IPO. I'm like, okay, fine. Then there is something which is not sitting right.
Had you seen An Academy and Byju's? As a,
Unacademy, we have not really spent much more time on because honestly, like I met the founder once. It's backed by somebody whom I really trust quite a lot, and like I really like Karthik, who sits in the board of the company. But I realized that it is one of those businesses where they are going for the hockey stick, and it won't fit well with our investment thesis. So that's the reason why we did not even spend the founder's time much. Similar was the case of Byju's. Again, we had opportunity to invest in it 3 times. But again, and we said like, look, the way they want to build the company and the way we want to engage with our founders doesn't match. So probably not waste the founder's time. So let's not engage.
Phenomenal. Amazing. Thank you so much for your time, Anand. It was an eye-opening conversation.
Indeed. Thank you, Akshay. Thank you very much for spending the time with me, and hopefully this can be useful for your listeners.